and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
Electric vehicles will play a major role in India's emissions reduction goal. But the heart of an EV, its battery, is mostly imported. For India to become a major EV player, it will have to master battery making. Given the capital-intensive nature of the sector, Indian firms will have to grab a share of the global battery demand pie to turn a profit. So can Indian industry succeed in this ambitious venture? Baswa Kumar has the answer.
Recent extreme weather events are a clear sign that the world has been sleepwalking towards the crisis that is man-made climate change. If we want to meet this challenge, then greening the global transport sector, which the UN Environment Programme says is the fastest growing greenhouse gas emitting sector, is vital. That is where electric vehicles come in as the chief instrument. The extent of their adoption in India, which is expected to be the fastest growing major economy in the years to come, will in many ways determine whether that goal is achieved or not. But India may fall short of its ambitious targets. According to the Niti Aayog, if the FAME2 program and other measures are successful, India could have 80 million electric vehicles on its roads by 2030. But an analysis by Climate Trends and JMK Research says that the country may only be able to reach 50 million EV sales by 2030, falling 40% short of the Niti Aayog's projections. One of the reasons could be that in the price-sensitive Indian market, purchasing costs have continued to be a problem. Goa's power minister, Sudhin Dhavalikar, has a solution. According to him, once their batteries are manufactured in India, the cost of EVs should come down by half. So, it is imperative that India become a major EV battery maker. But that's easier said than done. While technologies like green hydrogen are also being explored, they are still in the nascent stage. At present, the most common type of technology used to power electric vehicles and for energy storage are batteries made of lithium ions. They also contain other materials like nickel, manganese, and cobalt. They convert electrical energy into chemical energy, allowing for the storage of electricity in a very dense form. And they will remain the key drivers of green mobility going by their projected demand, which will reportedly jump 17-fold from over 500 gigawatt hours in 2020 to 9,300 gigawatt hours by 2030. And that presents a significant challenge for India becoming a global EV battery maker. According to government data, as of July, no reserves of resources of lithium-bearing metals were part of the national mineral inventory, while the presence of lithium resources amounting to 1,600 tons has been detected in Karnataka. They fall in the inferred category, and thus the associated confidence level is low. Therefore, India will have to largely depend on imported lithium in the near term. India's imports in this category in FY21 stood at almost 9,000 crore rupees and increased to almost 14,000 crore rupees in FY22. China and Hong Kong were the major sources of imports. This has also exposed Indian industry to price volatility, with prices of Chinese lithium carbonate increasing by more than 400% in the past 1 year due to demand outstripping supply. To address this problem, the government recently initiated talks with a number of lithium-rich countries to supply the mineral to Indian companies. The Ministry of External Affairs had held a meeting with the ambassadors of Argentina, Chile, and Bolivia, among others. But Akshay Singhal, the founder of Log9 Materials, which makes batteries for EVs, says that the government's approach in this matter is still passive. Singhal explains that most of the other EV markets, like the US and China, already manufacture lithium-ion batteries. Thus, they can immediately use the lithium, But India, which doesn't have active manufacturing at present, can only make promises and speak about future sourcing commitments once manufacturing goes on steam.
One way to kind of break that kind of a issue and also to secure supply chain in long term is to get into this play, create stockpiles, strategic stockpiles, wherein they start to buy these materials. So basically, they start supply chain, they start the inflow of lithium and other critical materials required for lithium ion manufacturing, and strategic stockpiles are created, which once large-scale manufacturing comes up in the country, can be sold to the industry.
In August, Hyundai Global Motors Private Limited withdrew from the production-linked incentive scheme for advanced chemistry cell battery storage worth 18,100 crore rupees. The move came after it emerged that the South Korean automobile major Hyundai Motor Company was not affiliated with Hyundai Global Motors. Back then, it was reported that the government would allocate the 20 gigawatt-hour capacity awarded to Hyundai Global Motors to Reliance New Energy Limited and Mahindra & Mahindra. Apart from these two firms, the government has signed agreements with Rajesh Exports and Ola Electric Mobility Private under the PLI scheme. The participants are expected to create a total advanced battery manufacturing capacity of 95 gigawatt-hour. Meanwhile, the center will reportedly notify another PLI scheme for more advanced EV battery technologies, like solid-state batteries, soon. According to reports, at least 6 companies are in discussions for the additional scheme. While these are encouraging developments, India has a long way to go. First, a report by management consulting firm Arthur D. Little says that India will need to invest more than 82,000 crore rupees towards cell manufacturing to meet just the domestic demand for lithium-ion batteries by 2030. And remember, success as a battery maker will involve tapping into global demand as well. We also do not know how successful India will be in following China's footsteps, which became a dominant player in the EV battery space by mastering each part of the supply chain. A plethora of policy interventions may be required. Greater collaboration between the government and industry will be necessary. The government will need to bring in comprehensive policies addressing the entire EV battery value chain, from the acquisition of raw materials to even the recycling of batteries. Tax subsidies and the establishment of lithium parks to boost investments in raw material refining and cell manufacturing will also be necessary. More investments in allied sectors are also needed to increase demand for EVs and make battery manufacturing more economical.
Bottleneck one is the energy infrastructure. When you're buying an expensive passenger vehicle in the US, you can afford a large battery. You have the ability to park this at home and charge this at home. So, going electric is far easier. When you suddenly look at India, you realize that most people can't afford a large battery, right? Because of the price sensitivity. So you would realize most segments in India can only have an 80 or 100 kilometer range battery. Beyond that, it makes the vehicle prohibitive to own. At the same time, I don't park at home. A large portion of India parks on the roads. Right? So how do I park and charge overnight? So suddenly I need public charging, the reliance on public charging. And I think different people are solving for that, maybe a swap solution or a rapid charging solution. And I think that's needed to really unlock the 90% of the Indian market.
While Australia and South America are the largest suppliers of battery-grade lithium in the world, it is China that controls the midstream. That involves processing the lithium into hydroxides and carbonates, which are then used in cell factories. So, the next steps by India must focus on the entire EV battery value chain in order to break this hold.
India's EV sector may be off to a good start, but banks have clearly missed the bus. In RBI Deputy Governor T. Ravi Shankar's words, they failed to scale up the UPI in early days, and the opportunity was grabbed by non-banks. Two of them, PhonePe and Google Pay, now rule the space with about 82% market share, and it seems their free run will continue as a 30% market cap mandate will not come into force for another 2 years. So what does it mean for new players like WhatsApp, Debar Gasanial's report answers this question.
In a relief to the country's two biggest UPI players, PhonePe and Google Pay, the National Payments Corporation of India, or the NPCI, has deferred the implementation of its mandate, which sought to cap the market share of third-party apps at 30% by another 2 years. Market share of both the UPI players is above 30%. According to the NCPI's October data, PhonePe controls 47.26% of the total market share in terms of volume, while Google Pay has the second biggest slice of the pie at 34.17%. Paytm was a distant third at 13.62%, while Amazon and WhatsApp Pays take up less than 1% each. In November of 2020, the NPCI had come up with the directive to cap the share of transactions a third-party app could process at 30% of the volume of transactions handled on UPI effective January 1, 2021. It was to be calculated based on the volume of transactions processed during the preceding 3 months on a rolling basis. But what was the rationale behind the move? The NPCI directive was aimed at ensuring a level playing field for all the players and limiting the dominance of two large apps. The payments watchdog was banking on smaller players such as WhatsApp, Paytm, Tata Neu, and a few others to up their game substantially. But so far, they have not managed to do so. But now, NPCI has extended the deadline for the volume cap by 2 years. In a circular, it said, taking into account the present usage and future potential of Unified Payments Interface and other relevant factors, the timelines for compliance of existing TPAPs which are exceeding the volume cap are extended by 2 years, that is until December 31st, 2024 to comply with the volume cap. However, will the move not help the two big players and restrict the growth of newer third-party apps? And what are the implications of the move for the rapidly growing UPI market?
So there are two facets to it. One is this move, the extension of not having a cap, obviously does not help the new entrant. It also doesn't help the people, provider, service provider who are under the cap, like below 30% in that case. And why a government will continue to sort of extend this period is purely to not break any habit or a pattern. Then the government would have thought not to displace or disrupt the good habits which have come on the UPI side as opposed to the cash transaction, and also allow some more maturity in the infrastructure. We still see a lot of new entrants who are coming in, need to build infrastructure so that there is a higher degree of success and real-time settlement.
While Escorpay's Ashwin Chawla agrees, he believes the government should further restrict entries and expansion of companies.
No brand or no fintech has risen to the level of these two entities which are already operating. And because of that reason, I believe the government, rather than sharing and splitting that business of these two companies to spread over the other fintechs, I think a lot of work needs to be done in terms of technology, reach, compliance, protection, fraud management, and so on, to be allowing other users to operate at that level. I think it is very imperative for the government to identify the right set of players in the industry, patch up and allow access to only those operators which can take the responsibility of serving 1.4 billion people.
Even as UPI has found popularity as a payment ecosystem, it doesn't translate into big bucks for the players. So how will market dominance help Google Pay or PhonePe? Kathuria points to the way future revenue models can be developed.
Today, there are no income associated directly with the UPI transaction for the service provider. But the real business model really rests around having acquisition of customer and the ability to cross-sell various lending, asset products, credit card offering, bill payment, and so on and so forth, which is where the convenience fees and some of the other revenue models will develop. And which is why you will find more thrust in terms of customer acquisition when it comes to between a player A to B. And then they're trying to sort of curate those models and market segments that kind of they hold on to more strongly. But the revenue model is really about cross-selling and upselling various products on the platform.
Chawla, however, stresses that UPI should remain free to use.
UPI has to be free, and that's the reason players like the two names that you took, they are operating as super apps in terms of payment, so that once when a client enters your ecosystem, touching UPI or any other aspect of it, obviously KYC and other protocols get touched in some way. So he eventually indirectly becomes your client, and then you've got a gamut of services, upsell, cross-sell opportunities to sell and earn.
The NPCI's recent move does seem paradoxical to its earlier directive of easing the entry and expansion of new players into the UPI space. Experts, however, believe it is in the best interest of the UPI ecosystem as well as the consumer. They believe the sector needs to mature before newer players are allowed to enter and expand more freely.
Moving on, after a sharp rally of the past couple of months, equity markets are in a bit of a consolidation mood. The next triggers for the markets are the RBI's policy outcome and the results of Gujarat polls, both of which will be revealed this week. Our next report takes stock of what all is priced in by investors and how different outcomes may sway the markets.
Two major events, the Reserve Bank of India's monetary policy outcome and the result of Gujarat and Himachal Pradesh state elections are lined up for this week. The RBI began its three-day monetary policy meet yesterday and is due to announce its decision on Wednesday. The assembly poll outcome for the two states will be declared on Thursday. Analysts believe the monetary policy outcome will assume greater significance for the markets as the action will have long-term impact. This is because the action will cast a spell on the future trajectory of interest rates, forex reserves, and the rupee's value. Meanwhile, the impact of the assembly poll outcome, analysts say, will be factored in a day or two. But what are the markets pricing in right now?
The market's expectations of a lower rate hike from the RBI rests on two factors. First, inflation seems to be coming down and the future numbers could be smaller. Inflation has eased from 7.41% level to the 6.77% level. This has brought in some amount of optimism on the future trajectory of inflation. Therefore, RBI could go in for a lower rate hike. Second, the Fed also sounds less hawkish, with likely moderation in the quantum of rate hikes in the coming FOMC meetings. Inflation seems to have peaked, but one needs to be aware of the potential for some inflation persistence due to the volatility in oil prices. We need to carefully assess the impact of the sanctions that are about to set in and the effect of the capping of Russian oil prices. With a stronger than expected winter and the holiday season setting in, the dynamics could be more challenging. But the scope for excessive tightening to fight inflation may be over for the time being. State election results are not so much relevant today except for some hints about the continuity of the governments and the policies. There is no need to attribute too much of importance to these elections.
As suggested by Thomas of MK Wealth, oil markets remain dynamic, especially after price cap on Russian oil. Besides, there is always a slight possibility of actual election outcome being different from exit polls. So, how will a different outcome sway equities?
If this 25 to 35 bips rate hike does not get materialized and RBI stays put, then you might have a positive reaction from the market in the short term, but this could lead to pressure on Indian currency, which will be negative for the markets in the medium term. If the rate hike is more than 35 bips, then you probably could have a negative impact on the markets in the short term. But the markets will stabilize itself in the medium term. With respect to the Gujarat state elections, any reaction in the market, according to us, will be short-lived.
Today's market action will be guided by stock-specific news flow, foreign fund activity, and other global cues. Exit polls released after market hours yesterday will also dictate the market mood today. While analysts attach less weightage to assembly poll outcome, trends from exit polls and the actual election outcome on Thursday will be seen as a precursor to the general elections, which are less than 2 years away.
Staying on with markets, SEBI had introduced participatory notes in the year 2000 so that the foreign investors could also have a slice of India's growing stock market pie. But in 2000, when it thought of regulating it, the markets crashed like 9 pins. The regulator shelved the plan, but not the unease. Meanwhile, foreign investment through this instrument continues to swell. So what is a P note and what are SEBI's concerns around it? Watch our next report to know more.
By the end of October, the foreign investment in the Indian markets through participatory notes or P notes touched 97,784 crore rupees, the highest this year. In September, it was 88,813 crore rupees. Experts believe that slowdown in the global economy and India's good showing has led to this jump in investments. But why do foreigners choose P notes to invest in markets? If you want to start trading in the Indian equity markets, you will go to a stockbroker and get yourself registered by submitting a set of documents. The online process is a tad easier. But what if you're a foreigner looking to invest in the Indian stock markets? Then a cumbersome process of registering with the Securities and Exchange Board of India or SEBI awaits you. Avoid such a pain. Foreign investors go to an institutional investor who is registered with SEBI and invests in the Indian stock market on their behalf. The institutional investor then issues a participatory note to the individual on whose behalf the investment is made. So, a participatory note is a financial instrument, a type of offshore derivative instrument with Indian shares as underlying assets. While foreign investment in the India economy is usually a good sign, SEBI does not fancy it. It is because, unlike an investment made by an Indian citizen, the P-note investments lack transparency. While domestic investors are registered with SEBI through a broker, the foreign investor is not registered with the Indian regulator. This essentially means that foreign individuals can take anonymous positions in the Indian stock markets. Many high-net individuals take advantage of this to save tax. Since the actual people whose money is being invested in is not recorded by SEBI, the risk of unaccounted money flowing into the Indian market is very high. It is also possible that money obtained through illegal means could find its way through P-notes. To keep a check, SEBI has directed all foreign institutional investors to submit a monthly report on all P-note investments. Only Category 1 institutional investors can register with SEBI for P-note investments. The Category 1 investors are considered safe and include the type of governments and pension funds.
I will achieve, I will fly high.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Of the over 97,700 crore rupees that came into India through P-notes in October, over 88,000 crore rupees went into equities and about 9,000 crore rupees were invested in debt. Hybrid securities saw an investment of 190 crore rupees. That's all for today. Catch the next episode of The Morning Show tomorrow. Bye-bye for now.
For more news, views and updates, subscribe to Business Standard on Google Podcast, Apple Podcast and Spotify. Also follow us on YouTube, Vimeo, Instagram, Twitter, Facebook and LinkedIn.